Hello and welcome to the Banker's View from Sibos video series looking at all the hot topics here in Sydney. I'm Joy Macknight, Deputy Editor at The Banker, and I'm joined by Diane Reyes, who's Global Head of Liquidity and Cash Management at HSBC. Diane, thanks so much for joining today.
Thank you for having me. It's very kind of you.
So I think the last time we met in Geneva in 2015, you identified some of the challenges that corporates were facing at the time, including the economic environment, the regulatory environment, and also their large cash holdings. Do you think the situation has changed, or how has the challenges changed for corporates?
Thank you for remembering our conversation a couple of years ago. I think many things have changed, but a few things have actually stayed the same. So if we start about the economic environment, I really often think as a banker about interest rates, and it's quite relevant to my product. So the US dollar over the last 2 years has had several rate rises, and we've all been able to help our clients in that regard and get our hands around that. The sterling actually has recently increased for the first time in a long time, so that's quite exciting for all of us, particularly us. We're obviously a headquartered UK firm. But other currencies, if we talk about the yen or the euro, have really not progressed, so there's been no rate improvement there whatsoever. So customers are looking at that. Some of them are actually concentrating into the dollar or into the pound, and others are taking a wait-and-see attitude on the yen maybe or euro positions. So that's definitely on their mind. Now on the cash holdings, since it's been 2 years and the economic environment has improved, many of them have actually done strategic deployment. So what I mean is they've maybe purchased another firm, opened up a new manufacturing facility, possibly hired more staff so they have more points of distribution or in more locations. But they still always have that core operating cash. That's what comes into their account from their customers and what they send out to their counterparties, whether it's the payroll for the employees, whether it's for the stockholders, if you will, or it could even be supplier payments, of course. They still have that. And of course they want maximum yield on whatever's in that concentrated account, whether on an overnight basis. So that is definitely a priority, and we are focused on liquidity yields and money market funds.
Do you think that there will be greater interest in money market funds in the future?
I think there'll be a continued interest. You may remember, I'm pretty sure we were just beginning to roll out a product called Liquidity Investment Solution. We call it by an acronym, of course, LIS. And that was because customers were bringing deposits to us that some other institutions were actually not interested in having, given the rate environment. And what we decided was our relationships are so critical that we didn't want to turn anybody down. So we found a way to move the deposits off our balance sheet and still give customers some yield. It might be smaller spreads, but it was still something. And the way we did that was creating these access into the money market accounts. So in our case, the liquidity investment solution went into Goldman, BlackRock, JP Morgan, and of course our very own asset management group. And it gave them choices, and they then have to compare it to their investment profile and choose. So we can actually hook them into those options and give them some yield and keep the deposits with HSBC. So we've seen a continued increase, particularly for the non-bank financial institutions. So they're the ones that really were looking for this enhanced yield. But we've done two other things since then. We've actually developed a portal, so it's called our Liquidity Management Portal. And this allows those same customers, and we just rolled it out about a month ago, and we've got about 24 customers, corporate customers interested. It allows them to drill into their environment, to their deposits in their accounts with us and other banks, and find out what's the essence of those deposits, what currencies they're in, where they originated, where the money come from, or where's it going, so they can look at the turnover of those deposits and they know what they can count on. And the good news is it helps them before they have to go to the capital markets and raise a bond or even potentially draw down on a bank credit facility or be charged an overdraft fee. They can look at the deposits around the globe and get that yield and lower their costs before they go to the market. So I think we see a lot more customers interested in liquidity-related capabilities.
So how are your corporate clients reacting to Swift GPI?
That's actually a great question. I think the corporate customers who are beginning to see the benefits are reacting very favorably. But I think it's important to actually explain what GPI is. We use so many acronyms around here, and it's actually about one thing. It's actually two words, but one theme: tracking payments. So HSBC has always known that customers want to know where their payment is in the cycle, and we created a capability in our digital channel some time back, which we call Move Money, which is basically just moving money in whatever manner they choose to, so that they now know what it means, but also where it stands. So if they have made a payment, they can tell that within our payment tracker. If it's gone through the various checkings to be sure there's deposits in their account, we can tell that there's sufficient funds. If in fact it's then gone outside the bank, they can also tell. Now, until GPI, we could only tell them about within the walls of HSBC, and we consider that our end-to-end. But customers actually want to know it end-to-end, even outside the bank that they're making the payment with. So they want to know, when did it get to the beneficiary? Swift GPI allows us to do that. It allows us to tell them, once it's left our premises, has the Benny gotten it, and if so, when, and have they received the full amount that they were expecting? So Swift has 280 banks that are using GPI right now. I'm proud to say HSBC's probably got the largest volume, but we've enabled 90-some% of our volume through GPI. And what we did is we didn't change the mechanism for customers to access us. They still can go into the move money, but we can show them further on into the work stream. We also have over 90 currencies on this capability, so customers are actually starting to see it. So they see a lot of transparency. They not only see the status, but they're actually able to see, have there been any fees deducted from those payments as it goes through in any type of manner, and they're aware and can have discussions if they need with their banks. It also allows them to see what's happening from a reconciliation perspective, who's paying them, so there wouldn't be too many suspense items. But it's actually happening real time. Credit inquiries and payment inquiries are dropping to being responded to within a minute or two, whereas it could have taken days in the past. So I've seen a huge cycle improvement, and I think the corporate customers really, really like that.
Excellent. Thank you so much for your insights, Diane.